Good afternoon, everyone. All of you are welcome. After the pleasant hearing what we have got and the verdict what we have got from the Supreme Court, we are back to discuss some boring terminologies. Rather than saying boring, I'll say that as a part of Finance First Vertical, we had promised that we'll continuously do this knowledge series. And as a part of that knowledge series, I am again representing myself, Ramanujam Narayan. I'm heading the vertical at Contetra for the Finance First division. So today we have been discussing about lease accounting in the past. We have discussed about financial instruments. Today's topic is very interesting. It is income taxes and the impact of income taxes on the accounting side, particularly from an Ind AS and IFRS perspective. So the thumb rule is all of you pay attention for the first 45 minutes and we keep our full focus on this particular presentation and what I speak, right? Because this is a very interesting topic and I want you to focus on this. And the point is under Indian GAAP and when we have studied chartered accountancy, majority of us have left this AS22 in option, and I'm sure about it, all of you would agree to me. So when I talk about income taxes, right, so we start with the basic concept, right? What are income taxes? So income taxes, friends, some people say that income taxes are taxes paid on income. Do you really agree that these are income taxes or taxes paid on income? No. So friends, one thing what we need to remember is income tax or tax is always on profits of the business. When I say profits, it is ultimately the taxable income of the enterprise, where you do traditionally you have been doing a lot of IT computation, where you term something known as a disallowances, something known as an allowances. Now, why is income taxes appearing as a specific standard or a specific literature in accounting? Does it make any sense to all of us? So guys, you have to realize one fact. In Hindu mythology, it is being said that, Ram is incomplete without Lakshman. In the same way, in income taxes, the current tax is incomplete without deferred tax. Confused? Not really. So let us, simplify it by taking a live example. So let us start with current tax, right? What is the current tax? Current tax is basically taxes which we pay ultimately to the government of India, right, on our profits. So current tax, there is no confusion. I'm sure there is a way to disclose. It comes on the face of balance sheet, etc. The predominant and primary confusion, friends, is always there in deferred tax. Let us make it, very simple. As far as understanding of deferred tax is concerned, let us make it very simple. So from today, one thing what you have to remember and one thing what you have to keep in mind is when I talk about income taxes comprise of current tax plus deferred tax, right? And current tax is always calculated. There is a specific formula which has been given by the government, and now they have come up with a new set of accounting standards to complicate things further in the form of ICDS, right? Income Computation Disclosure Standards. So income tax provision is something which we have been learning since the last 50 years, where we prepare typically a traditional computation of income. We start with the profit before tax, we add certain disallowances. There are typically 43B sections, 40A sections, right? There are specific penalties what we disallow, and then we take certain allowances for specific exemptions what we have, and for specific allowances which we claim based on payments. That is typically the IT computation what we do, and that is calculated as per provisions of Income Tax Act 1961. Now, guys, what is deferred tax, right? So just let us, before getting into deferred tax, let us discuss a simple example which we can understand deferred tax pretty better. You have a specific income statement where your profit is, 1 lakh INR, and there is a bonus provision after that where it is about 20,000 INR. So the profit for the year in the books of account is about 80,000. This is profit before tax credits, right? Now, as far as current tax computation is concerned, all of us know, for that matter, that under 43B of Income Tax Act, bonus provisions, certain statutory provisions, certain gratuities, or whatever disallowances are there, that is not allowed unless you make the payments for those, right? The moment I disallow a specific item under income tax, I have to pay a tax on that. So here is where the computation of income is prepared. Basically, profit for the year is 80,000. Now, over and above that, I'm disallowing something known as unpaid bonus under 43B, 20,000. So my taxable profit becomes 1 lakh INR Now, assume that in the jurisdiction of India, the statutory tax rate applicable is 30%. So I have to pay tax on 1 lakh, which is 30,000, right? Up to here, it is very clear that my taxable profit is 1 lakh INR and my tax on that is 30,000. Now, if someone asks you what is the effective tax rate of the company, what will be your answer? So guys, this effective tax rate concept is the most important concept when it comes to income taxes. Every stakeholder of a company makes an emphasis on this particular concept, be it a shareholder, be it an investor, be it a CFO, be it a CEO, be it analyst or any community. Why? Effective tax rate of the enterprise denotes what is the tax that you have paid on your profits, right? What is the tax that you have paid on your profits? It is a representative number saying that, guys, friends, government, income tax, stakeholders, analysts, communities, investors, listen to me. This is the profit of 1 lakh. On that, I have paid 30,000, right? So when I say 1 lakh, it's a taxable profit. But what is my book profit? It is 80,000. So I have paid 30,000 of tax on a 80,000 profit. Now, friends, if I ask you about ETR, what is effective tax rate? I said that tax paid on profits. So basically, it is income tax charge on my profit before tax, right? It is income tax charge based on profit before tax. So in this situation, if I talk about profit before tax of the enterprise, it is about 80,000, right? And the tax is 30,000. So what is my effective tax rate in this case? It is 38%, right? And why is this happening? Because I have disallowed bonus. So if I talk about the first situation where it is a typical profit before tax of 80,000, and if I have paid a tax of say 30,000, my effective tax rate is 38%. Wow. So the government, the investors, the analysts, and all the other communities say that I'm paying 38% tax on my profits. Why is it the case, right? The analysis of effective tax rate makes you an intelligent finance professional, right? When you are a finance professional, you should know what an effective tax rate is. Remember my words, guys. Don't become a specialist, become a generalist. मुन्ना भाई में बोलते हैं ना कि छाती के डॉक्टर को नहीं पता कि मतलब कान में क्या होता है, ऐसे नहीं होना चाहिए. It should not be the case that we as doctors don't know that what is happening inside the stomach if you are a heart specialist. You should always be a generalist. Effective tax rate is an accounting concept, but it should be known by tax professionals, investors, M&A guys, investment bankers, and all other accountants as well. Now, coming back to our example, we are talking about an effective tax rate of 38%. Really? So what's happening? It is happening because this bonus, what I'm disallowing, I'm going to pay tax on that. Now, at any point of time in future, are we going to have any tax consequences as far as this bonus is concerned? So what we have to think is this bonus, from an example perspective, when will it get allowed in income tax? It will of course be on payment basis. That means in the next year, I'm going to allow it based on the payment, what I'm going to do for bonus. So this 20,000, at some point of time, I am going to get a tax deduction, right? So this 20,000 becomes a temporary difference. So when I talk about temporary differences are those items which are going to get reversed in the subsequent years or at some point of time. Now, traditionally, you would have heard about the term timing differences, temporary differences. All of this is one and the same. And the simple concept of deferred tax is you create a deferred tax asset or a liability based on future tax consequence. So in this situation, in the first case, if I don't create a deferred tax asset, logically, then basically my effective tax rate will be 38%. Now, why deferred tax asset? You have to simply go by the concept of accounting profit or tax profit for the time being, right? The accounting profit in this example is 80,000. The tax profit is basically 1 lakh. So which profits are higher? Tax profits. That means you are paying more taxes today and you are going to get a deduction in future. So if you are going to get a tax deduction in future, as of today, it has to be a deferred tax asset. So in this situation, you will end up creating a deferred tax asset on 20,000. Okay. So the deferred tax will be on the favorable side. So your tax charge will go down. So if you look at case 2 in this specific example, there is a 1 lakh taxable profit. there is profit for the year, which is book profit known as 80,000. There's a current tax of 30,000. But in case 2, there is a deferred tax credit which is coming to my P&L of 6,000. So total taxes become 24,000 and profit for the year becomes 56,000. This is PAT. So you don't have to get confused. From an effective tax rate perspective, in the second case, it is 30%. There's no magic, guys. So deferred tax becomes very relevant. Whatever we have left is left in options, forget it. Deferred tax is as simple as this. So moving forward, now since in this particular example, the bonus provision had a tax consequence for sure. Are there any items where there are no tax consequences in the future at all? Can we think about that? We can think, right? For example, certain penalties which we pay on statutory payments, right? So on that, typically, are we going to get a tax deduction at any point of time? The answer is no. We are not going to get tax deduction at any point of time. That is basically on the disallowances side. On the allowances side, imagine there is an IT company and it is claiming an exemption under 10A and 10AA, and they are typically in the technology park, and they are getting their 100% of their profits are exempt. Now, imagine on this particular 1 lakh of profit, if I get 100% exemption, there is not going to be any tax. There is not going to be any future tax consequences. Now, when it comes to disallowance and allowances, or when it comes to timing differences can be either temporary, where it is going to get reversed in the foreseeable future, or all these items where there is no tax consequence in future at all is known as permanent difference, right? So if there is a permanent difference, let us take an example, right? What is a permanent difference? In the same example, I have a profit of 1 lakh. I have a bonus provision of 20,000, and there is also a penalty of 10,000, penalty on statutory payments. And all of us are studying from class 1 that penalty on any statutory payments is disallowed from an income tax perspective, right? So when we prepare the current tax computation, we start with the profit for the year. Now in this situation, the profit before tax becomes 70,000 because of this penalty. So I start with 70,000. I add an unpaid bonus of 20,000, and I add a penalty of 10,000. So my taxable profit becomes 1 lakh, right? And my tax becomes 30%. So my tax becomes again 30,000, right? So in case 1, when there is no deferred tax, right? When there is no deferred tax, I again take a profit before tax of 70,000. My current tax is 30,000 if there is no deferred tax. Right? If there is no deferred tax, I'll take 30,000 of tax on my 70,000 of profit. Right? Now, in this situation, my effective tax rate is income tax charge divided by my profit before tax. It is 43%. Now, why is this happening? It is happening because of 2 accounts. One is bonus, one is penalty. Now, bonus was I will fight with income tax. I will do several computations, and in some of the subsequent years, I'll definitely be able to claim this 20,000 as an allowance, right? That's the reason it is a temporary difference. But on the contrasting side, if I talk about this penalty, this 10,000 INR, I'll never be able to get a deduction as far as income tax is concerned. So this is the concept of permanent differences, guys. And trust me, evaluation of permanent differences is not a cakewalk. We have to really see. For example, there are several permanent differences on which there is no future tax consequence at all. Biggest example is mutual fund deduction, what we claim, right? Under section 10, subsection 35D, where you don't have to pay any taxes on income received from mutual funds. There are penalties, there are donations. All these are permanent differences where today, whatever taxation we decide, there is no future tax consequence. To that extent, wherever there is a permanent difference, there cannot be any deferred tax impact. So in the second situation, in this case, if you see, I create a deferred tax asset on this bonus and my total tax becomes 24,000. But the only difference is because of this permanent difference, my ETR, effective tax rate, is going up by 4%. And now it is 34%. So the concept of effective tax rate becomes very, very, very relevant as far as any jurisdiction is concerned. So One thumb rule, guys. One thumb rule. One thumb rule. All of you need to by heart and implement in your daily life. In case if a particular company has got, a particular corporate has got any only temporary differences, and if they do not have any permanent differences, their effective tax rate has to be exactly equal to statutory tax rate. Means if the statutory tax rate existing in the jurisdiction of India is 34%, their effective tax rate also has to be 34% if there is only temporary differences. But if there are any permanent differences, your ETR will definitely be different from the statutory tax rate existing in the economy. I hope all of you got a sense of what is permanent difference, what is temporary difference, what is deferred tax, and what is effective tax rate. Let's move forward, guys. If you see this effective tax rate chart, in the first case where there is no deferred tax, the effective tax rate is about 43%. And in case 2, where we create a deferred tax asset, it is 34%. Obviously, if there is a deferred tax asset and a deferred tax credit, then your effective tax rate has to go down. So if you see, there is a concept known as tax reconciliation. Now, this is another kick what you're going to get when you prepare India's and IFRS financial statements. In Indian GAAP, you have never heard about a concept known as tax rate reconciliation. Tax aaya, deferred tax kiya, whatever is the tax charge, you divide it by your profit before tax, you are done. But in case of IFRS and in case of Ind AS, you have to give a tax rate reconciliation. That what is your estimated statutory tax rate, okay, and based on that, what is your tax coming in the books of accounts, and what is the reconciliation difference. So if you see this example, my profit before tax in case 1 is basically 70,000. My tax is 21,000 actually, but I'm getting a tax of 24,000. So the difference is on account of permanent difference of 3,000, but tax as per books which I recorded is 30,000, right? Because I did not create a deferred tax. So there is a difference of 6,000. But when I see it in case 2, I have a profit for the year of 70,000. My estimated tax is 30%, which should be 21,000, but I am getting a tax of 24,000. So the difference is only on account of permanent difference. This is a perfect tax rate reconciliation what I have done as far as case 2 is concerned. So the thumb rule, guys, if there is no permanent difference in the enterprise, okay, then your statutory tax rate and effective tax rate has to be one and the same. But if there is a permanent difference, then your effective tax rate will be different from the statutory tax rate existing in the economy. So we have always heard about, P&L approach, balance sheet approach. Let us study today finally what does it mean. Indian GAAP always used to follow P&L approach. What does it mean? Whatever gets debited or credited to P&L, the disallowances happen based on that, and the allowances happen based on payments. It is as simple as that, right? If you record a bonus provision, it is disallowed. If you have some expenses on which you don't have, we are not paid at TDS, it gets disallowed under 40A. That is P&L approach. Now, come to balance sheet approach. When the standard talks about balance sheet approach, it takes into consideration two things: the tax base of an asset and the book base of an asset. Tax base of a liability and book base of a liability. That means you don't have to look at a P&L item alone. You have to look at a larger perspective, that is the balance sheet, right? It is very much relevant when it comes to a specific example known as interest receivable. In an economy, if there is a interest receivable which is taxed only on cash basis, right? Not on accrual basis. Now I'm changing the theory itself as far as India is concerned, because India accrual basis of accounting is followed, and based on accrual you have to pay tax. But if I talk about the situation, only one request, guys. I will complete my presentation in 45 minutes, and after that I can have a number of questions, because I want to cover a specific perspective. So I would appreciate that you hold on for just some time, and then you ask questions after 45 minutes. Okay, and whatever query you have, and even if it is a basic query, I'll be more than happy to sort it out. Right? Now coming back to our example, when I talk about balance sheet approach, I take basically interest receivable. If it is taxable on cash basis, then logically speaking, I'm going to pay tax only when I receive the interest payments from the bank. So as of today, I'm not going to pay any tax, but on that profit, I have to pay tax in future. So as of today, I need to have a deferred tax liability because the tax base of the asset is 0 and the carrying value is 1000. If I have an interest receivable of 1000, then logically speaking on that 1000, I'm going to pay tax in future. So today I have to create a deferred tax liability. This is known as balance sheet approach in the simplest sense, that you have to consider every balance sheet item and you have to create a deferred tax based on the concept of tax base of an asset, book base of an asset, tax base of a liability, book base of a liability. Don't get tensed, right? If at all you don't understand this concept, okay, then you simply apply the concept of tax profits and accounting profit. Your answer will be the same. If tax profit is more today, accounting profit is less today, there will be a deferred tax asset. If tax profit is less today, accounting profit is more today, then you are paying less taxes and there will be a deferred tax liability. Traditional items on which we have always seen deferred taxes is depreciation, where there is a difference based on Companies Act and accounts and income taxes. There is bonus, there is gratuity, there are 40 items, there are penalties, there are other items where there are temporary differences. Now, let us come to those items from an IFRS and India's perspective, which does not go to P&L at all. Which are those items? Those items are the items which goes to other comprehensive income, right? OCI. Simplest example, actuarial gains and losses. If actual gains and losses is going to OCI, on that also you have to have a deferred tax asset or the deferred tax liability, as the case may be, because that actuarial gains and losses which is sitting in OCI, that also has to go net of taxes. This is the implication when it comes to balance sheet approach, because on actuarial gains and losses, the deferred tax asset or the liability under Indian GAAP always used to go to P&L, because actuarial gains and losses always goes to went to your gratuity expense, and based on that your deferred tax also used to go to P&L. But which is the biggest difference, guys? In India as an IFRS, the actual gains and losses will go to OCI and corresponding deferred tax will also go to OCI. Similarly, what is a cash flow hedge? Cash flow hedge is typically for your highly probable forecast transaction. The mark-to-market profits or losses or the fair value will always go to your cash flow hedges in the reserves. Now, one is technical, one is logical. Now, technically speaking, on cash flow hedge, if it is going to OCI, when you are going to realize this cash flow hedge, it will go to P&L. So if on realization you are going to pay tax, then logically today the cash flow hedge has to be net of deferred tax. Now, logically speaking, this cash flow hedge reserve, what I am showing, is it the true value of the reserve? The answer is no, because on realization definitely there is a tax consequence. That tax consequence needs to be recorded today, right? So this is the kind of implication what it has as far as deferred taxes based on balance sheet approach is concerned. Next example, we have never seen deferred tax implication on intercompany consolidated adjustments. In the consolidated books, simplest of example, if company A sells an asset to company B, which is in the same group company, and the book value of that asset is 100, and A sells the asset at 150 to B, that 50 rupees unrealized profit always get eliminated, right? And the corresponding incremental depreciation what comes in the books of B, that also get eliminated. Now, if I am following Indian GAAP, I'll blindly take the entire taxes from the standalone books and directly take it in the console. Now, as a consequence, your effective tax rate will definitely be higher, because your consolidated profit will be lower to the extent of the unrealized profit, but the tax will flow from the standalone books of accounts. Now, what happens in India as an IFRS? The international standards are very matured, and they say, boss, this specific reduction in profit, okay, and the specific increase in the effective tax rate is coming predominantly because of this item of elimination of unrealized profit, and to that extent your profits are lower but the tax is the same. So the standard says you can create a deferred tax asset to that extent, right? And to the extent of depreciation reversal, you have to reverse the deferred tax asset which you created. These are the kinds of adjustments what typically comes as far as the new approach is concerned. So the balance sheet approach of India as an IFRS is a very matured concept, and you need to take into consideration what kind of adjustments I take in balance sheet, what kind of adjustments do I take in OCI, what kind of adjustments I take into P&L. The respective deferred tax will also go to the respective line items that it belongs to. Like the items which belongs to P&L, the deferred tax will go to P&L. The items which belongs to OCI, the deferred tax will also go to OCI, right? Now, the biggest change, the melodrama which has happened in the economy of India is the reduction of tax, right? So all of us are excited. All of us are excited. The tax rate has gone down from say 34% or the base rate of 30% to 22%, right? And the MAT has gone down to 15%. And this change is effective FY 1920, right? So what are the implications as far as FY 1920 is concerned, guys? First of all, you have to understand in the jurisdiction of India, majority of your companies will always will fall under the tax umbrella of 20 to 22% because Government of India has already given a lot of exemptions to Indian entities, be it manufacturing, be it research, be it service. To that extent, if they are getting the exemption, their ETR is already 20 to 22% or less than that also. Now, what are the implications, right? Now, logically speaking, if the tax rate is going to go down to 22%, there is going to be a savings as far as cash flows are concerned, right? There is going to be a decrease in current tax charge and the present cash outflow is going to reduce. But guys, have you imagined that in the previous years, whatever disallowances you have taken, right? And you would have created a deferred tax at a rate of 34%, right? Because deferred tax has to be accounted always based on enacted or substantively enacted rates. So deferred tax is basically created for the future tax consequence is what we have studied. The future tax consequence in the country of India, it is going to be on 22%. So the deferred tax, what you have created at the rate of 34%, will have to be taken based on 22%. So what is the result? Your deferred tax charge will significantly go up, indicating the loss of future tax benefit. That means, simple example, if you have disallowed something under 40A at the rate of 34%, your future tax computation will get an allowance of that same disallowance at 22%. So I will not be a critic and say that government has done something right or wrong, but time has come to introspect, guys, that what is the consequence we are talking about and what are the benefits that we are talking about, right? So the points to note is, although tax rate has reduced, the ETR for 2019-20 is always going to be on a higher side because of the reversal of deferred tax. Current tax will not have any implication because it will be computed at the rate of 22% plus surcharge of cess. But deferred tax for the current year will be calculated at 20%, but there will be a reversal to the extent of the March 19 deferred tax what we have created, as a result of which all listed companies, all unlisted companies will see an effective tax rate going up significantly for FY 19-20, right? The lower tax rate, second point, very, very, very important, guys. The lower tax rate is without any tax exemption such as tax holiday or SEZ. Means what? If you are an SEZ, if you are an STPI, STPI has already got over by 2011, so I will not talk about that. But if you are an SEZ, if you are a manufacturing enterprise, if you are R&D center who is already taking the SEZ benefit, you cannot enjoy the lower tax benefit because you would have certain MAT credit which will be there for you. Your SEZ profits will not be taxable, so you will already be at an ETR of 20%. So how does it benefit you, right? So this is the kind of consequence what we need to envisage. Now let us talk about MAT, right? What will companies do who already have a lot of unutilized MAT credit and unabsorbed depreciation? They have two options as a thumb rule. Option one, shift to lower tax rate and forget all the MAT credit which is there and all the unabsorbed depreciation which is there, which means I will have a lower tax rate for the current year and I have to forego all the tax benefit that I had, that I was carrying in my tax return and my balance sheet. Option two, I continue to pay tax at same old rates and switch to lower tax rate once my MAT credit and unabsorbed depreciation or brought forward losses is utilized. Very smart move, guys. Go back and introspect what kind of benefits have you really got. This will definitely be beneficial. This step will definitely be beneficial for the manufacturing entities which are going to come, which are going to open their doors in current year, where the tax rate is going to go as low as 15%, or new startups who are paying tax at the rate of 30%, they will get a benefit of 22% of tax, right? they are the only people who are going to take a tax benefit. One tip to you guys: CA practitioners and other practitioners or people who are working in the LLP, limited liability partnership, they have to introspect and see to it that their LLPs also get converted into private limited, because in LLPs, this is not covered in any literature, guys. The LLPs are already being taxed at the rate of 30%. You can get a tax benefit of 8% on that also. And you can convert your LLP into a private limited company, thereby paying a tax at the rate of 22%. And the surcharge and cess is over and above that. Points to note in this case is switching to a new tax rate will be a one-time choice. Companies have to evaluate which of the option is more beneficial. They will have to basically do a cost benefit analysis, that if I utilize the MAC credit, what is my benefit, what I'm getting in terms of cash flow. If I'm utilizing the new tax rate, what is the tax benefit that will come to my P&L and my cash flow. Intelligent analytical thinking needs to be there. If you have only a tax knowledge or only an accounting knowledge, or only analytical knowledge, you are zero. You need to have the knowledge on all the three aspects. What is accounting, what is tax, what is analytics, and based on that you have to take this decision. Companies with huge MAC credit unabsorbed depreciation is likely to opt for old rates only, right? This is the kind of implication which is there, guys, as far as new rules are concerned. I think I'm done with my presentation. Be it Contetra as a part of Finance Cost Division continue to give the knowledge series in the form of new concepts which are getting emerged as a part of the new compliances what are coming, and as a part of our diploma and IFRS batch also, our trainings are absolutely practical. And again, I would like to emphasize on this call that we are not here to advocate anything on joining of our DIP IFRS batch. Of course, if you're interested, you can join, but we'll continue to do this knowledge series wherein you will continue to get a lot of knowledge from my side and my team side, and I would encourage a lot of participation in this webinars, thereby discussing core principles and discussing practical issues. With this, I open the house for questions.
Hi, sir. I hope you are doing good.
Yes, sir. Yes. Very good. Tell me.
Yeah. Thank you for your session. It's a very knowledgeable session. Very useful for us, like our professional guys, accountants, as well as tax guys, and also tax accountant guys. My query is about OCI. We are approaching balance sheet approach only. I have a little bit knowledge gap between the treatment of OCI. Can you elaborate about OCI method for deferred tax calculation?
Very good question, Manju. I really appreciate this. So I'll probably try to explain it. So what items typically go in OCI? Okay, there are restricted items which goes to OCI, like a loss or gain on a cash flow hedge, or say actuarial gains and losses, which does not have any P&L impact. The logic under IFRS and Ind AS is very simple. These items, for example, the mark-to-market gains and losses, what I take it to say OCI on account of cash flow hedges, or say mutual funds. Okay, if mutual funds, if I'm disclosing it as available for say securities, and if I take the loss and gains to OCI, then logically on realization I have to pay tax on that. The standard says very clearly, if on realization you're going to pay tax, then on all the items that is going to OCI in future, if you are going to pay tax, then you have to record a deferred tax asset or a deferred tax liability as of today, right? So logically speaking, every item that goes into OCI has definitely got a tax consequence in future. So if there is a tax consequence in future, then you have to create a deferred tax asset or liability today. So whatever item goes to OCI, what items typically goes to OCI? All notional items, which is going to go to my P&L in future, right? If it is going to go to my P&L in future, like say cash flow hedges, gains and losses, or say FCTR, typically which when it will go on disposal, or evaluation surplus, all these are temporary differences, and ultimately I have to create a deferred tax based on that. So every item that goes to OCI is a temporary difference, and I have to create a deferred tax consequence for that particular item. Manju, I hope I have answered it. Any other questions? You can raise your hand. It was a very good question raised by Manju. So Manju, I'm putting you on mute if the question is answered, or you can speak out if you have any further questions. So there is one more question, that which amount should be considered for deferred tax? Who has raised this question? So this is again from Manju's side. So logically, whatever items goes to other comprehensive income, the deferred tax has to be recorded based on that amount. For example, if I'm taking a gain or loss to the extent of 1000 INR to OCI, I have to create a deferred tax for that 1000 INR at the rate of same statutory tax rate what I have, right? If it is 30%, then you will record 30% of 1000, right? Which is 300, and you will record a deferred tax asset or liability based on that. Is it clear, Manju? Okay. So can you tell me about rate changes call in the deferred tax? Right. So the rate changes, I'll give a live example. I'm doing an NBFC in one of the state. I'm doing an NBFC company in one of the states, that is Kerala. So over there, basically what they have been doing is they have been paying tax at the rate of 34%, and suddenly what is going to happen is the tax rate has become 22% as of today. So they have recorded all their deferred tax asset at the rate of 34% as far as closing of March 2019 is concerned. Now that March 2019 assets will get reversed, and the YTD asset of deferred tax will get recognized as of today at the rate of 22%. As a result of that, there is going to be a tax hit for the differential between 34% and 22% in deferred tax. And my deferred tax charge will go up, and my effective tax rate will also go up as a consequence of that. Is it clear, Manju? Okay, let me pose this very simple question and let me see how many of you have understood. So I can see an answer. Permanent differences are those where there is no tax consequence at all in future. That's correct. I appreciate this. So permanent differences are all those differences where you don't have to pay tax or you're not going to get any tax benefit as far as future is concerned. So I would continue, and I would like to have active participation from all of you, and I would really appreciate if you can pose your questions. Don't be tense that what will people think. It is a public forum and I have organized a webinar, so I would expect all of you to raise your hands and ask questions. Bindas. Okay. So if at all you have any subsequent questions also, you can, I will wait for a couple of minutes and I would see if you want to ask any questions on this call, or else we'll close the call and you can pose your questions and my team will get back to you. So let me wait for a couple of minutes if any one of you want to ask any questions from your end. So there is a question which I appreciate. What is balance sheet approach for deferred tax calculation? Can you please re-elaborate? Okay. Balance sheet approach is very simple, where you don't go by what has got debited to PNL or credited to PNL. You go beyond the conventional signs of PNL and see that what are the tax consequences as far as balance sheet items are concerned, right? Like for example, I spoke about OCI. OCI ultimately is a reserve item which goes and sits in balance sheet, right? Why am I considering any deferred tax calculation for that? Because there is going to be a tax consequence as far as balance sheet items are concerned. Similarly, what I do is I see what is going to be my tax base and book base. For example, take the same example of fixed assets, right? I depreciate a particular plant and machinery in books at 20%. I depreciate in tax at 40%, right? So in books, I am taking 5 years, and in tax, I am taking 3 years, for example. So logically speaking, there is a difference between a tax base and the book base of an asset, and my carrying value at the end of first year in the books will be based on 5 years of life, and in tax, my WDV will be go down because I'm going to depreciate at 40% or 3 years, right? If I depreciate it in 3 years, I am taking a higher tax benefit as of today. So my book base and tax base is different. So I basically end up creating a deferred tax liability as of today. This is the way you have to analyze the balance sheet, that what is going to be my tax consequences as far as future taxes are concerned. So rather than going by the P&L approach, I go by the balance sheet approach and see, for example, accounts receivable. If there is a country like Zimbabwe or any other European country where the revenue is taxed on cash basis, so as of today, the entire accounts receivable, okay, I'm not going to pay any tax because the tax is payable on cash basis. So the entire revenue what I have recorded will be untaxed. Whereas I'll have to pay tax in future. So the book base of the accounts receivable is say 1000, but the tax base is 0. So there has to be a deferred tax liability, right? Because I'm going to pay tax in future. So this is known as balance sheet approach. I hope you got a sense of it. If not, you can re-raise the question. For each line item in the balance sheet, we have to look for deferred tax. Ideally, yes. Ideally, yes. For each line item of balance sheet, we have to look at deferred tax. But traditionally, whatever approach you use, P&L or balance sheet, your answer cannot be different except for India's adjustments. For example, depreciation, what I spoke about, in P&L approach also the deferred tax answer has to be the same. The balance sheet approach also the answer has to be the same. Interest receivable and accounts receivable, the example what I give can be different only when I have the revenues being taxed on cash basis. Only then the book base and tax base will be different. Otherwise, but for all practical purposes, the revenue is always taxable on accrual basis. So there is no difference in balance sheet and P&L approach. This comes into the play only in specific items of consolidation and OCI items and business combinations, and specific items which go is in balance sheet, but there is a future tax consequence, like cash flow hedging reserve or whatever item goes to OCI. But regular items like provision for doubtful debts, say depreciation, say PN bonus disallowed, 48 disallowances, everything is a temporary difference whether you follow P&L approach or balance sheet approach. The answer will be one and the same. Have I answered your question? Most welcome. Any other questions, guys? I'm liking it. The participation is very good. So I would expect more questions to come. We have the forum open for how many minutes now? 5 to 7 minutes more. Okay. There's one more query. Give example for rate change impact for deferred tax. Let us take a simple example that if you have a profit before tax of 1 lakh and if you have created a deferred tax asset on a bonus disallowance as at March 19 of on say 10,000 INR, you have created a deferred tax asset at 34%. So 34% of 10,000 is 3,400. If you have not paid that bonus and if you are going to pay it only in the subsequent year, so this year also the deferred tax assets have to continue. But in this year, on this 10,000 of base deferred tax, the amount on which you will create deferred tax will be 10,000. That is the same, but the deferred tax amount will be instead of 34%, it will be based on 22%, and instead of 3,400, the deferred tax asset will be 2,200. So there is a deferred tax reversal to the extent of 1,200, guys. So effectively your deferred tax expense will go up and your effective tax rate will also go up and your deferred tax asset will come down. I hope you understood. There's the next question. What is the tax liability if provident fund is not claimed and yet appears in the balance sheet in the hands of the company? If provident fund is not claimed, or if provident fund is not allowed, then logically it is a 43B item and you'll have to disallow it in income tax and you have to create a deferred tax asset in the books of the company. Because provident fund, if it is not claimed, then logically it has to be disallowed. Provident fund, there are 2 to 3 approaches. Either you can have your own trust or the trust is with RPSC, but the rule is you have to deposit the provident fund with this trust. If you have not deposited, if you have not paid provident fund, then you have to disallow it. But provident fund, beyond the point, if you don't pay, then that will be termed as a permanent disallowance. Employer's contribution goes in 43B, employee contribution go to other clause, and employee contribution is a permanent disallowance. Please remember this. If it is not paid on time, then you cannot claim it in income tax at any point of time. I hope you got your answer. Any other questions? Okay, that's a nice feedback which we have got. It's okay. So thanks a lot, everyone. I'm expecting all of you to participate in my next webinar also. Contract Trust Finance First Division promises to share continuous knowledge to whatever extent it can. And every day there will be an incremental enlightenment for sure. Thanks a lot. Looking forward to see you guys in the next webinar. Thank you.